I want you to close your eyes for a second. Well, unless you're driving, please don't do that. And just picture your typical Saturday morning grocery run. You grab a cart, hopefully not that one with the squeaky wheel that pulls left, and you head for the cereal aisle.
The yellow box aisle.
Exactly. It's comforting, isn't it? So familiar.
Yeah.
You've got your Cheerios, your Lucky Charms, the Cinnamon Toast Crunch. It feels incredibly stable, almost timeless. It's like the anchor of the whole store.
Oh, absolutely. It's been the anchor for 50 years. I mean, that's the visual definition of breakfast for millions of people.
But then, okay, keep walking. You go past the dairy, past the frozen pizzas,
Yeah.
all the way to the other side of the store, the pet food aisle. What does that look like now?
It looks like a completely different planet.
It really does. It's just
Yeah.
booming. You've got these refrigerated glass cases, you've got grain-free options, ancestral diets, specialized stews for cats with, like, anxiety. It looks more like a high-end health food store,
Yeah.
but for your dog.
And that contrast you just described between that steady, almost nostalgic cereal aisle and that explosive premium pet aisle, that is the entire story of General Mills right now.
Right, because we usually think of them as just the cereal giant, the Wheaties company.
Yeah.
But looking through the research you pulled, the Q2 fiscal 2026 earnings, the strategy reports, it really seems like they're in the middle of a massive identity crisis.
Mm.
Or maybe an identity shift is a better word.
It's definitely a shift, and a very high-stakes one. Look, we're talking about a company trying to turn a legacy food business into a modern growth engine. And they're making a billion-dollar bet that we love our pets just as much as, if not more than, we love our own breakfast.
So that's our mission for this deep dive. We're looking at General Mills ticker GIS for the investors out there. We've got a huge stack of sources, earnings, transcripts, balance sheets, even legal filings, and we need to figure out, is this aggressive pivot a genius turnaround? Or is it what they call a value trap just waiting to spring?
That's the multi-billion-dollar question. Because to fund this whole pivot to pets, they are selling off huge chunks of their human food business. They're effectively burning the furniture to heat the house and just hoping the new renovation pays off before the fire goes out.
That sounds incredibly risky.
Yeah.
Okay, let's start with the mothership then. Before we get to the dogs and cats, we have to talk about human food. North America retail.
Right. This is still the biggest slice of the pie. It's, 61% of their revenue. This is the core. Cereal, snacks like Nature Valley, meals like Old El Paso. If this part of the ship sinks, the whole thing is going down.
And looking at the data from the last few years, this part of the business has been taking on water, hasn't it?
Struggling is a polite way to put it. For the last 4 years, they've had this persistent volume problem.
Meaning people just weren't buying as many boxes.
Yeah. Exactly. Revenue looked okay on paper because inflation let them jack up prices. So, you pay $7 for a box of cereal instead of $5, and the company makes its revenue target. But the actual number of boxes leaving the factory, the volume was falling. People were just getting sticker shock.
I think we've all felt that. You're standing there looking at a box of cereal and you think, do I really need this? Or can I just eat toast?
And that hesitation is exactly what General Mills finally tried to address in Q2 of fiscal 2026. They rolled out this new strategy they call the Remarkable Experience Framework.
That sounds like some classic corporate speak. Remarkable experience framework. What does it actually mean for me, the shopper?
Well, the most critical part of it is something they call fixing the price cliff.
The price cliff. Okay, break that down for me.
So imagine a literal cliff edge. On the top of the cliff is the price of, say, a General Mills name brand cereal. And way down at the bottom of the cliff is the store brand, the generic Toasted Oats or some budget competitor.
And there's always a gap, right? You expect the name brand to cost more, you're paying for the G on the box.
Right. But because of all the aggressive price hikes over the last few years, that cliff had become too steep. The gap between the name brand and the generic was so wide that people just wouldn't make the jump anymore. They were trading down. They looked at that cliff and said, nope, not climbing that.
So General Mills realized they had priced themselves right out of the cart.
Precisely. So they identified the products where that cliff was steepest, about 2/3 of their entire portfolio, and they adjusted the base prices.
2/3. Wow, that's massive. So they basically just lowered prices.
In some cases, yeah. In others, they just held steady while competitors went up. The point was to compress the gap. And here's the headline news from Q2 that got Wall Street so excited. It worked. For the first time in over 4 years, their organic volume actually grew by 1%.
They finally got people to put the boxes back in the cart.
They did. They gained what they call pound share, which is just market share based on the actual weight of food sold in 8 of their top 10 categories.
Okay, so if I'm an investor, I'm popping the champagne. The core business is fixed. Volume is back. The price cliff is solved.
I'd put the cork back in the bottle for just a second.
Why? What's the catch?
This is where reading the footnotes in the CFO's commentary really pays off. You have to listen to what Kofi Bruce, the CFO, actually said. He mentioned something he called an air pocket.
An air pocket, like turbulence on a plane. That doesn't sound very stable.
It's a warning about the quality of that growth. He explicitly said that the volume beat in Q2 was partly due to, and I'm quoting here, shipment timing benefits.
Translate that for us.
It means they shipped more product to the retailers, to Walmart, Kroger, Target, than those retailers actually sold to customers. They stuffed the channel a little bit.
So the sales happened between General Mills and the warehouse, not necessarily between the store shelf and my pantry.
Precisely. And they had some supply chain luck that let them ship faster than usual. Management was very, very clear about this. This is going to unwind in Q3.
So next quarter, the numbers might look worse because the stores are just working through all that extra inventory.
Exactly. So is the core business stabilizing? Yes. But don't let that one positive volume number fool you into thinking it's rocket ship time. It's fragile. That air pocket means we could see a dip before we see any real sustained growth.
Okay, so the cereal aisle is stable-ish,
Yeah.
but with a big warning label attached. Let's talk about the part of the business that's disappearing. You said they're burning furniture. I assume you're talking about the big divestiture.
Melting ice cubes.
Yoplait.
Yoplait.
I grew up on Yoplait.
Yeah.
That specific cup shape, the foil lid you had to be so careful with. It feels like a staple. But General Mills just sold their North American yogurt business for $2.1 billion. Why sell a brand that everyone knows?
Because in business, known doesn't always mean growing. Yogurt was a drag on the portfolio. It was a low-growth, low-margin asset. It was just pulling down their overall performance averages. So they made a strategic call to cut the dead weight.
Even if that means losing revenue.
Even if it means losing a lot of revenue. Selling Yoplait created a $4.9 billion reported revenue drop. That's about 7% of the entire company just gone. They are literally shrinking the company to try and make it higher quality.
Shrinking to grow. That is a bold strategy. It's like cutting off an arm to lose weight. So they take that $2.1 billion in cash from the yogurt sale. And where does it go?
They walk it right over to the pet aisle. This is the strategic inflection point. They want to take North America Pet from 13% of their revenue up to 20%.
And looking at the highlights here, pet sales jumped 11% in the quarter. That looks fantastic compared to the 1% in human food.
It looks fantastic on a billboard, yeah. But again, you have to peel back the onion.
I have a feeling you're about to ruin this number for me, too.
Just a little bit. That 11% growth, 10 points of it came from an acquisition. Only 1% was actual organic growth from the brands they already owned, like Blue Buffalo.
So they bought the growth.
They bought it. Specifically, they spent $1.45 billion to acquire a company called Whitebridge Pet Brands.
Whitebridge. I don't know the parent company, but I think I know the brand. Tiki Cat.
Yes, Tiki Cat. And this is a very specific, very clever signal. General Mills owns Blue Buffalo, right? That's a massive brand, but it's very heavily indexed towards dogs.
Okay.
The data shows that the dog food market is actually starting to slow down.
Really? Why? I feel like everyone I know has a dog.
It's demographics and housing. People are moving into cities, apartments are getting smaller, so people are still getting pets, but they're opting for smaller dogs who eat less food, or they're getting cats. The cat market is actually growing faster than the dog market right now.
So buying Tiki Cat is a hedge. It's a we need more cats strategy.
Exactly. It balances the portfolio. But they are not giving up on dogs. In fact, what they're doing with dogs is, I think, the single most interesting and risky thing in this entire report.
You're talking about the fridges.
I'm talking about Love Made Fresh.
This fascinates me. We are seeing dog food move out of the dry aisle and literally into refrigerators. General Mills is launching this under the Blue Buffalo brand. But this isn't just a new recipe, is it? It's not a new flavor of kibble.
No, this is an infrastructure war. I mean, think about the logistics of selling a bag of dry kibble. You bake it, you bag it, you throw it on a truck, sits on a shelf for 6 months. It's easy, it's cheap to move.
Very low maintenance.
Now think about fresh, refrigerated meat. You need a cold chain, you need refrigerated trucks, but more importantly, you need a place to actually put it in the store. You can't just stick it next to the milk. People don't shop for dog food in the dairy aisle.
You have to bring the fridge to the pet aisle.
Correct. You have to physically build, ship, install, and then maintain thousands of these branded refrigerators.
That sounds incredibly expensive.
It is wildly capital intensive. They hit 4,658 coolers by Q2, and they want to hit 5,000 by January 2026.
And they're going up against Freshpet, right? I feel like Freshpet just owns that space. I see their fridges everywhere.
Freshpet created the category. They have that first mover advantage. General Mills is trying to muscle in using the Blue Buffalo brand name.
And is it working?
The early stats are promising. They captured about a 5% market share in the markets where they launched.
5% doesn't sound like a lot.
It's a start. But remember, Freshpet is the 800-pound gorilla in the fridge. The real risk here isn't just that they won't sell the food, it's the execution. I mean, if those fridges break, if they aren't stocked properly, if the electricity bill eats up all the margin, this becomes a very, very costly experiment.
And while they're focusing all this energy and money on the fancy refrigerated food, what's happening to the regular old kibble? Because most people still just buy the bag.
That is the big warning light in the report. Their core sub-brand, Wilderness, which is their high-protein dry dog food, is performing, and this is their word, unacceptably.
Unacceptably. That is surprisingly blunt for an earnings call. Usually they'd spin that with words like headwinds or challenges.
It suggests real frustration. It suggests that while they're chasing this shiny new fresh object, the bread and butter business is leaking. And this is the danger of premiumization. If you tell everyone fresh is best, fresh is love, what does that implicitly say about your dry kibble?
You're kind of telling your customers that your main product is second rate. You're cannibalizing your own reputation.
Exactly. If they lose the core while they're chasing the niche, the math just doesn't work. You can't fill a leaky bucket by just pouring water in faster.
Okay, so let's recap the board. We've got a stabilizing cereal business, but with an air pocket. We've got a sold-off yogurt business, which means shrinking revenue. And we've got this massive, expensive bet on pet fridges and cat food.
Right.
You can't do all that without moving a massive amount of money around. Let's do the financial health check. Because if I'm an investor, I'm looking at the balance sheet and I'm starting to get a little nervous.
You should be. This is where that value trap argument starts to get some real ammunition. To pay for Whitebridge and all these moves, their net debt has climbed to $13 billion.
$13 billion.
That puts their leverage ratio, that's debt compared to their earnings, at about 3.5 to 3.7 times.
For listeners who aren't CFOs, is that high?
For a steady, boring consumer staple company. Yeah, it's getting uncomfortable. Ideally, you want to see that under 3.0. When it gets this high, it just means you have less flexibility. If something goes wrong, you've got this heavy backpack of debt weighing you down.
But the number that really stood out to me in your notes was the free cash flow.
This is the most critical number in the entire report.
Lay it out for us.
In the first half of the year, General Mills generated $960 million in free cash flow. So that's the actual cash left over after running the business and, buying all those fridges.
Okay, nearly $1 billion. Sounds pretty good.
But they spent $1.16 billion on dividends and share buybacks.
Wait, do the math there for me. They spent more on paying shareholders than they actually made in cash.
They did. They outspent their cash flow by about $200 million.
So how do you pay the difference? You can't write a check. You can't cash.
Proceeds from divestitures, they are literally using the cash from selling the yogurt business to bridge that gap.
That feels unsustainable. You can only sell the yogurt business once.
Exactly. It's like selling your furniture to pay the rent.
Yeah.
You can do it for a few months and your landlord is happy, but eventually you run out of chairs to sell.
Now, to be fair, management says this is temporary, right?
They do. They expect cash flow to improve a lot in the second half of the year as that air pocket clears out and the new acquisitions get integrated. But right now, they're walking a very tightrope. They're prioritizing that dividend payment above almost everything else.
Let's talk about that dividend. It's over 5% right now.
It is. And that is huge.
In a world where savings accounts are starting to pay less, 5% is really attractive.
It's why a lot of people own this stock. It acts like a bond. You buy it, you hold it, you get your 5% check every year. It's supposed to be safe. But if they're borrowing money or selling assets just to keep paying that dividend, the quality of that payout degrades.
It's not coming from profit. It's coming from liquidation.
In the short term, yes. And that's the risk. If the pet bet takes too long to pay off, that dividend might come under some serious pressure.
So the internal financials are a bit of a yellow flag. But General Mills doesn't operate in a vacuum. We have to talk about the external world. the consumer.
The stressed consumer.
This came straight from the CEO, Jeff Harmening, right?
It did. He specifically talked about the consumer who earns under $100,000 a year. He called them stressed.
Which, let's be honest, is a massive chunk of the population.
It is. And their behavior has shifted. They aren't buying more food. They're becoming value seekers.
Which brings us right back to the coupons.
Exactly. The cost of volume is rising. To get that stressed consumer to buy a box of Cheerios, General Mills has to issue more coupons, run more promotions, do more deals.
So even if they sell the box, they make less profit on it.
Their margins get squeezed. It's a grind. And then, on top of the stressed consumer, you have the government.
The San Francisco lawsuit. I saw the headline on this, but I didn't dig into the details. What's happening there?
So the city of San Francisco, representing the people of California, sued General Mills and a few other companies. The claim is basically that they're creating a public health crisis with so-called ultra-processed foods.
This feels heavy. Is this like the big tobacco lawsuits from the 90s?
That's the comparison that everyone is afraid of. The tobacco companies argued for years that they weren't responsible until suddenly the tide turned and they were on the hook for billions.
Is that a realistic risk here?
Legally, it's probably a long shot. These cases are very hard to win. But the reputational risk is immediate. It represents a shift in how society views these products. If ultra-processed becomes a dirty word like cigarettes, that hits, what, 80% of General Mills' portfolio?
Yeah, it's pretty hard to market fruit gushers as a fun snack if the government is calling them a public health crisis. And speaking of health trends, we should probably mention the GLP-1 factor, too.
The elephant in the room. The weight loss drugs, Ozempic, Wegovy.
Right. If millions of people start taking drugs that suppress their appetite, what's the first thing they stop eating?
Snacking. And General Mills is a snacking giant.
Yeah.
If total caloric intake drops across the population, volume drops. That's a long-term kind of existential threat that they haven't really solved yet.
So you have a stressed consumer, a government lawsuit, and a potential pharmaceutical revolution reducing people's appetite. That is a tough environment to operate in.
It is. And this brings us all the way back to that contrast we started with. It creates a fascinating paradox for the company.
How?
Well, think about it. On one hand, you have the human food portfolio. It's facing lawsuits about health, it's fighting this ultra-processed label, and consumers are stressed about the price.
Right.
On the other hand, you have the pet food portfolio. What are the buzzwords there? Love made fresh, ancestral diet, feed them like family.
It's almost ironic. We're feeding our dogs these fresh, refrigerated premium meats, and we're feeding our kids processed snacks that are getting sued by the city of San Francisco.
It is the paradox of the modern consumer. And General Mills is betting the farm that they can win on both sides of that paradox. They want to be the solution for the busy parent who needs a quick, cheap snack, and the solution for the devoted pet parent who wants the absolute best for their fur baby.
It's a very complicated needle to thread. So we've looked at the cereal, the yogurt, the cats, the fridges, the debt, the lawsuits. What's the verdict? If we look at this objectively, is General Mills a turnaround story or a value trap?
I'd call it transitional purgatory.
Purgatory. That does not sound fun.
They're doing the right things, logically. Fixing the price gaps was necessary to stop the bleeding. Dumping low-growth yogurt was just smart finance. Chasing high-growth fresh pet food is the right strategic move for the future.
Right.
But the execution risk is massive. They are leveraging up the balance sheet to do it. They have very, very little room for error.
And they're relying on selling off assets to cover the dividend in the short term.
That's the scary part. If the Love Made Fresh bet doesn't pay off, if those coolers don't generate enough sales to cover the cost of the trucks and the electricity, then General Mills is left with a lot of debt, $13 billion of it, and a core business that's still struggling to grow volume without just cutting prices.
So if you're an investor, you're looking at that 5% dividend yield, and you're asking yourself, is the reward really worth the risk?
And you're watching that wilderness dog food brand like a hawk. If they can't fix the leak in the dry dog food business, the fresh food growth isn't going to matter. It'll just be a bucket with a hole in the bottom.
It's a fascinating case study in trying to turn a massive ship around. You're moving all the weight from one side to the other, but you have to keep the engine running the whole time.
And hope you don't hit an iceberg called debt.
I want to leave our listeners with one final thought to chew on. We talked about the humanization of pets. General Mills is betting the farm, literally divesting billions of dollars on the idea that we will treat our pets like children, demanding fresh, refrigerated food for them. At the very same time, they are fighting legal battles over the food they sell for actual children.
It raises a profound question. Can a company successfully premiumize animal diets while fighting a reputation battle over human diets? Can you be the hero of the pet aisle and the villain of the cereal aisle at the same time?
That is something to think about next time you're pushing that cart with the wobbly wheel. Thanks for diving in with us.
Always a pleasure.